Let's now turn to the advisory. Our next guest highlighting the benefits of debt recycling and how you should be using it in appropriate circumstances. Matthew Ingram joining us from North Haven Financial Management. Matthew, welcome to AusBiz. So let's talk about then debt recycling. What's the actual definition? What are you talking about?
Yeah, so look, it's a term that's thrown around quite a lot. It's a bit of a hot topic at the moment. So I often have clients coming in and saying, I've heard about debt recycling. What is it? Should I be doing it? If you look on most online forums, there's probably people talking about debt recycling and why you should be doing it. But essentially what it is if you have non-deductible debt, what that means is if you have a mortgage on a home that you live in, then the interest that you pay on that mortgage is not tax deductible. If you have an investment property or you're borrowing money to invest, whether it's in shares or property, whatever it may be, you can generally claim the interest on that mortgage as a tax deduction. So it makes it substantially cheaper. Now, debt recycling is most basically a way to take some of that non-deductible debt and convert it into deductible debt to pay down your mortgage a little bit faster and make it a little bit cheaper.
All right. So how do you do that then?
So normally this makes sense for someone who comes in and they've got a mortgage for a home they live in, and then maybe a pile of cash in the offset account, or maybe they've got a share portfolio. So what you would do in that case, and look, this isn't suitable for everyone, but where it is suitable, what you would do is look to split that non-deductible mortgage that they have. So say you've got $100,000 saved up, you split part of that mortgage that you have. So there's a $100,000 split in there. You could then pay down that $100,000 with the cash that you have and then redraw that money. So now that money is for a new purpose. It's paid down part of your non-deductible loan and you've pulled it out and you go and invest that, whether it be in a share portfolio or property, you go invest that. And now that $100,000 is tax deductible because it's being used for income producing purposes. So you haven't actually taken on any more debt by doing that. You've simply paid down $100,000 and then redrawn it, but now it's tax deductible. And so you're getting that part of your loan for a bit cheaper because you're getting a deduction on it.
All right. What are the downside? What's the risk though?
Yeah, so as I said before, there is plenty of reasons to do it, but also plenty of reasons not to do it. There are risks involved with it, which is why you want to make sure you're getting a bit of guidance from a professional when you're doing it. Some of the risks are things like market risk, for example. If you're taking some money, borrowed money, and you're putting it into the stock market, you want to make sure that you have a decent time horizon, long enough to ride out any volatility and produce a return on that share portfolio. If that now drops in value and you owe $100,000 and it's now worth $50,000, you know, getting yourself in a little bit of trouble there. And look, the same thing can happen with property. You can borrow money, property prices can fall, but with something like a share portfolio where, you know, the value can be a bit more volatile, that's definitely a risk that needs to be considered. Also making sure that you have the cash flow to support something like this. I mean, repayments still have to be made. If you had $100,000, you could just pay down your mortgage and maybe lower your repayments if you go and refinance or restructure. But if you're going to do this, you're maintaining a significant level of debt. You need to make sure your cash flow can support that. And if you're expecting life changes, whether it's a change in your income or family circumstances, then you just need to be sure that you're actually able to support these repayments.
Yeah, and to that point then, Matthew, who is this most suitable then for in the stage of life, the assets you have and so on?
Yeah, it's most suitable for, well, firstly, you have to own your home, right? You have to have non-deductible debt. So that's step one. Anyone that just, you know, is renting or has an investment property or this is of no benefit to them. So if you have a home, but also if you are a higher income earner, now I know that's subjective, but when you think about marginal tax rates, If you're on one of the higher marginal tax rates, say 37% or 45%, those are the people that are going to get the most benefit out of doing this for two reasons. They typically have greater cash flow, they're earning more, so they're able to make these repayments, take on that little bit of extra risk. But secondly, because their marginal tax rates are higher, that means they're getting more of a tax deduction by converting some of this non-deductible debt to deductible debt. So they're getting more of a benefit out of it. I mean, if you're on the highest marginal tax rate of 45%, when you include the Medicare levy, that's 47%, you're essentially getting almost half of those interest repayments back as a tax deduction by doing this.